Thanks for tuning into Talking Point. I'm your host, Niraj Shah. The case for a chat today on a day, the day following a really strong move in the market. Would the DIF flows, which have effectively absorbed all of the FI selling for April, albeit for the last so many months, will they continue to drive the markets higher? We've seen some strength in the recent releases of some of the real estate ancillaries, particularly cement. Is that a bucket that you want to look at more actively? And is there some dichotomy between what select band of IT companies are saying versus what IT service companies are saying? In terms of minutiae, we'll try and get into that as well. But a lot of macro and micro conversations with Unmesh Sharma, Executive Vice President and Head of Institutional Equities at HDFC, joins us right now on the show. Unmesh, so good having you. Thanks for taking the time out.
Thank you, Niraj. Thanks for having me.
Constructive or skittish about prospects of risk assets, both global and local in nature?
Yeah, so that's, I think, the trillion-dollar question right now. The cross current, there is too much crosswind going on right now. Okay, so let's start from the top. If you look at the way in which the fight against inflation has happened globally, and I'll try to put it into an Indian context because not all of it is what happens in the US is really 100% relevant for us. The biggest issue that we are facing right now is the fact that the fight against inflation quite expectedly has been longer than you think. If you go back to the 1970s, this is exactly what happened at that time as well. You keep thinking that you are winning the victory. So if you remember, even in this round, there was this whole phase about it being transitory, and then there was a pivot backwards. And I think this word pivot has been used since, if I remember correctly, since August 22. I remember there was an article I had written where we had talked about the fact, is there a pivot? And they said, so that didn't happen. And then there was one earlier this year, maybe December last year. So what happened was that at that point in time, the market thought that there are going to be 7 rate cuts, while the Fed said it was 3. And the data this morning is that the bond market believes that there will be 0 or 1 rate cut this year. And I don't know if you know this, but in the data, if you really go deep, you will find that there is a set of investors who is actually hedging for even a rate hike. Now, that is a huge move. But the market's not fallen, okay? Because I think the liquidity has been sloshing around, and we can go into specifically in India what is happening. But at the same point in time, the risk reward on risk assets globally, and within that, I would say emerging markets and then India being a part of that, definitely the risk reward is not in favor of a very big up move from here. So yeah, that answers the first part. Yeah.
First part, yeah. The second part, therefore, is the market behavior over the last 9 months, being able to climb almost every wall of worry, right? And in some part, as you said, maybe due to domestic flows, because FIs have been rank net sellers, seems to suggest that if this were to continue, there is a bit of a safety net for markets. Earnings plus liquidity is a potent combination for climbing over some walls of worries. While the risk reward is not in favor, can India do slightly different? I would love for you to bring about the intellect that you have around what this global peace and liquidity means for Indian markets.
Yeah, so you're actually, there are a lot of layers in the question itself, so I'll try to address all of those. Okay, the first is that globally, while liquidity is sloshing around, you can see from the net selling in India itself that there is some risk off. In fact, if you look at the last week's data, there is a lot of flow which is actually happening into China. Now, this makes 2 points. One is that, does that mean that people are going away from risk? The answer is probably not. Why would you move from India to China? China, probably the risk is higher at this moment in time, given all that's going on over there. But what's happened is that there is some value bias which is coming in, because I don't know if you've seen, but across sectors, the valuations of a lot of very good quality Chinese companies is actually in single digits now, versus India, where the whole market itself is over 20. So what's happening is that there is some reallocation of portfolio happening. Now, so that's at the FPI level, and which is why that connects with your second point as to why FPIs are selling. So there is a reason for that to happen. So it's not necessarily complete risk off, but at the same point, because there is enough liquidity, but this. Now, then you come to the second point, which is something that to a large extent is unprecedented. Now, this is where you actually compare it to what happened in Hong Kong, China in 2004, 5, 6, 7, 8. Now, what's happened is that this huge wave of financialization of savings and people participating in the market has started, and which is what I think you can see from the SIP flows. Now, there are a lot of layers in that, but what's actually effectively happened is that all the bouts of selling which have come from the FPIs have just been completely absorbed by the domestic market. Now, here what happens is that this is a little scary in a sense, and if you look at the aggregate data over, I think the FPI stake in the India Inc. was peaked at around 23% and it's down 5-6%. Now, you know, maybe I'm too old school, but earlier if someone had told me that 5% of India Inc. is going to be sold by foreigners and nothing will happen, the market's actually gone up.
Yeah.
Okay. So, you know, it is also somewhere where people like us also have to take a little bit of humble pie, because I actually thought the market will fall this year, and that's been the call. And wherever I go, people keep asking me this. कि आप तो बोले थे गिर जाएगा, मतलब you thought that it's going to fall, but what's happening now? But now what I think is happening is that if you compare it with the example of what happened in Hong Kong, China, this can go on for a bit. The only reason why this would stop, and that is the second part of, you know, I'm preempting what you will then say, okay, how does this stop, is one is that as of right now, there seems to be not much interest in looking at aggregate valuations. So if company is delivering earnings, then keep buying. The counter corollary which supports this thesis is the fact that if you see even in this earnings season, and this is happening globally, not just in India, but globally, you see a small miss and the stocks fall dramatically, which kind of supports my thesis that a lot of this participation can go away if there is disappointment. And the second is that there has to be something else to buy, because this liquidity is real. And people have now kind of made money in the market, or at least not lost money in the market now for a long period of time. So unless something like a real estate or working capital or people start deploying money elsewhere, I think this will continue for a bit longer. Now, in this scenario, it's a little tough. And honestly, that's exactly what's happened to a lot of market participants, including us, thinking that, you know, at some stage it will stop. It has not stopped. And I think this will continue for a bit.
Yeah, and difficult to kind of call an end to it, because as you said, it's not something that too many of us have seen in the past. This kind of liquidity participation from the domestics in a meaningful way, direct PMS, AIF, mutual funds, and the passive flows, right? Pension funds, etc. Just one point before we take that break. It's very curious that the market, while it's punishing some of the companies which are missing, is not shy of disproportionately rewarding expensive stocks if they are delivering. Trent, a case in point yesterday, KPIT, a case in point yesterday, and there are countless other examples. I mean, it's just a dichotomous market. Punishment meted out to even weaker hands, even if the valuations are attractive, but complete blowout buying into some of the businesses which are delivering growth.
So, look, that's the nature of the market. I think given the fact that it's becoming incrementally more, if I may call it, domestic and retail, this tends to happen for short periods of time. Now, short could mean a year, could mean 2 years. What that means is that what is happening really is that not having any reason to sell becomes reason to buy the position. And you know, there is this mindset that if it's not disappointing, why should I, you know, why fix if it ain't broke, you know, that type of mentality. So I think that's what's happening. But at some point in time, this catches up. And, you know, for people like us who are constructing model portfolios, our research team, we quite struggle with this kind of scenario. But yeah, that's the nature of the beast at this point in time. Till there is disappointment, we can't see selling happening in the market.
You made this very valid point about concerns on the anvil, and therefore build a portfolio which can kind of suit the mindset that you bring into the table when you're building that portfolio, right? You and your team. What is the model portfolio like currently?
So, okay, so you start from the top. I think the biggest change that we made to our model portfolio, I think a slightly different approach is we never go over 5% cash, but we used to be 3, so it's gone to 5.
Okay.
Okay, so we have 5% cash now, and then what we've done is that we've added weight to the utilities. So there is the InvIT has come in, the PG InvIT has come in, for example. Now, more than just the fundamentals of that, more importantly is that it's a little bit of protection for your portfolio. So Power Grid, InvIT, NTPC, these are the types of names that we've added. All of these are overweights now. So without going into specific details, broadly what we are doing is that almost 8 to 10% is like a rock solid kind of bulletproof kind of portfolio. In the rest, what's happened is that we had a very, very good run in our model portfolio for 3 years, taking outsized bets, playing, if I may call it, domestic economy and value. But what's happened is that, value has one issue, is that if your call is right, then value is no longer value. And that's what's happened to our portfolio now. So what has happened is a lot of convergence has happened. And if you see, when we started to adjust everything together, we came to the point where everything was just getting closer to the index. And so I'll give you an example. We had a huge underweight position on levers, which was quite unpopular. A lot of pushback from clients, but it really worked. And we had a huge overweight on ITC. Now, that stock has done phenomenal. And I think we were one of the few fans of that when it was in the hundreds, somewhere between 100, 200. And we kept adding weight to that. Now, when it came together, what's happened now is that you don't know what to do because it's worked. And that is where the difficulty starts. Now, what has happened is that I think that the model portfolio now is in a position where for the larger companies, and it's not like we have a large cap bias in the portfolio, but we've naturally gravitated towards the larger caps because of the fact that that's where the value is relatively better. Now, this is also linked to my earlier point, which is that the participation has happened more from the domestics, which if you look at the way in which ownership of stocks used to be back in 2000, let's say 6 till even 20, was dominated by the FPIs. So there was natural bias towards consumers and large cap banks. But that kind of reversed over the last 4. But we are kind of now gravitating back towards that. So we have a very huge bias for that. A lot of things like consumer discretionary, which are just overpriced, we've just taken them off.
Even premiumization beneficiaries, you've taken them off.
Yeah.
Okay.
So premiumization, technically, Maruti also is a premiumization beneficiary in a sense, right? So and so is Hindustan Lever as well. So they have come closer to the benchmark. But what we've done is some of the discretionaries have gone off. So we are playing discretionary now indirectly. So we have real estate in there, which is not in the so Sobha in real estate has come in, even though it's not, there is no real estate in the Nifty. And then there is, things like media and all this. So we've added a few of these names in there to play that kind of theme. So what's end up happening is that the large caps are close to the benchmark and the expensive small caps have gone and got replaced by non-benchmark names.
Okay.
That's broadly how it's got constructed now.
Okay. Real estate is interesting, and the reason I find it interesting is because the pre-sales continue to be higher, despite the fact that the valuations may be a bit of a question. But the question that I have is for the ancillaries. So a lot of people have said that plywood hua, cement hua, whatever it is, they have not quite gained because inventory was there and that was getting sold. And now inventory is at whatever month lows, different statistics. And now that the newer construction is getting done, there will be a demand for ancillaries coming through, for cement coming through in a big way, etc., infrastructure plus real estate. Is that a valid argument?
Yeah, so look, we've been through this cycle very positive on the domestic capex cycle. And I would say equally excited about both the infra and the real estate. I would think at this point in time, given that there is elections coming up, so there has been a little bit of slowdown on that side. We are a little bit more positive on the real estate cycle, so as to speak. And the best way to play that is not just to own the real estate names, because these are all normally very niche urban plays. We are talking about the whole cycle. And in that, apart from having some cement names, I think we have JK Lakshmi in there. But we also have names like Stylum, for example. So we are playing it through that. And in fact, we have a team which actually looks at building materials together, not just there. At some stage, once the post-election lull is kind of gone, and we can expect to see some kind of pickup on the infra side again. Maybe the weight will shift towards cement a little bit more. But as of right now, on this entire space, we are quite constructive.
Got it. What about newer themes? I mean, this conversations with the government seems to suggest that rooftop solar, for example, right up there. Defense spends will probably stay right up there. Suddenly, out of nowhere, railways came into being for 3 years on a trot and gave some superb earnings surprises as well. What about some of these new or recently developed themes which might have a slightly longer runway? Power, for example, this hydropower and the wind power, etc., and those ancillaries too have given some strong guidances. What do you like here?
Yeah, so look, what's happened is that, okay, so one big challenge with all the four themes that you mentioned, in fact, one common theme is that it's very difficult to play these themes. The number of stocks which are genuinely high liquidity, also I work for institutional equities.
Yeah.
So one big benchmark that we have internally, it's a rule of thumb, it's not really a benchmark, is that a meaningful fund house should be able to build a meaningful position in the stock. Unlike our retail research team, which has a lot of these under coverage, we don't actually have that. And very simple rule of, I don't know, as in, this is one fascinating thing. Earlier, small caps, mid caps used to be 2,000 crores, 3,000 crores, 4,000 crores. And now, at 15,000 crores, is where you really start operating, because the size of the funds is so much. And in fact, some of the new IPOs as well, that's the conversation we have with fund managers, that how is this going to matter to me? The amount of work that you have to do to assess a company of 2,000 crores versus 20 is the same. And if it's not going to be, if I'm not able to put it as half or 1% of my portfolio, where the portfolio has become 25,000 crores now, how do you operate? So honestly, on all of these themes, we have not gone deep. What I, however, can make an anecdotal comment is a lot of these themes have run ahead of themselves.
Okay.
And basis some of the coverage stocks that we have. Because what's happened is that low liquidity stocks also invariably end up doing that. The pendulum swings too far. And in some of these, it may have happened. So I think we'll wait for some of these to become investable and see what happens.
Okay. One final question, and that is on the dichotomy between IT services and ER&D.
Yeah.
If you dwell on both of these spaces per se, because it's the same for the last maybe 12 to 18 months or 24 months. But even at the end of the quarter, when I speak to the ER&D guys, today we were speaking to KPIT before you came, or LTTS last week, the outlook for growth is a lot more confident and promising as opposed to IT services. Now, do you believe IT services are reaching a bit of a bottoming out phase or not quite, part one? And part two, despite that discretionary spending being not evident, could ER&D still do well despite the higher valuations?
Okay. So slightly tough one. So I'll give you a slightly more nuanced answer.
We have about 90 seconds. Sorry.
Okay. So the Indian IT services companies will figure it out. But we think that they are hitting an air pocket in the short term.
Okay.
So they will come out of this, but I think in the short term, there is a bit of a challenge there. So relative valuation is the only game in town. We used to have ER&D, but we think we're not comfortable with the values. A lot of these names we had under coverage and in the model portfolio, they're off it now.
Okay, sorry, I'm told we have some more time. If you can take some time and tell me, why is it that ER&D doesn't? Is it the valuation argument?
Yeah.
It is.
Yeah.
But they are, Unmesh, I'm just trying to think. They are talking of, KPIT is talking of maybe delivering 18 to 20% growth for the next 5 to 7 years, purely by auto, other adjacencies notwithstanding. LTTS is saying that we'll do 10% organic, and there is an inorganic move going to happen. Eventually, that will be whatever, 12, 13, 14, 15, 16%. So growth is there. So why then take them off?
Yeah, so, okay, so the model portfolio is also very concentrated. We want to play it that way. That doesn't mean we have no ad ratings in there. But a lot of our, if you see our long-term, 3 to 4 year kind of long-term Tata Elxsi type names, which were there, which we rode all the way. In fact, some of these, we made our name in the market pushing some of these ER&D players. I think at this point in time, we are getting to the point where we are a bit less emotional about them. And I think that on balance, are they great companies? Should you stay invested? Answer is yes. But hold recommendations don't make it to the model portfolio.
Got it.
Don't sell, but don't do anything. That is not going to get to the model portfolio. So the benchmark is high.
I get your point. Last question. What is the most active sell? It'll obviously not be a part of the model portfolio, but where is it that you're the most negative on?
I think on the metals, with the exception of Tata Steel, we have a huge underweight position. And a lot of it has to do with the imponderables of what is going to happen in China. Until the time we see a little bit more clarity there, I think, because you're asking for one, so I'm telling you that. That and some of the smaller NBFCs. In fact, even Bajaj Finance, we have a huge underweight, but that could correct, and we still like it, the business. But on the margin at the NBFC, looking at the way the asset cycle will play out over the next 2 years, and the imponderables in China, I think the metals names, with the exception of Tata Steel, we think are the two big underweights for us.
Great. Well, this was lovely having you in the studios, Unmesh, and look forward to have this kind of conversation more often. Just so good to do this in person. But thank you for your time today.
No, thank you, Niraj. Thanks for having me.
The pleasure was ours, and viewers, thanks for tuning into this edition of The Talking Point.